Hey everyone, and welcome to our DAT weekly market update. Believe it or not, it is March. This is our update for March 2nd, 2021. Thanks for joining us. I'm Ken Adamo, Chief of Analytics at DAT, joined as always by our Principal Data Scientist, Damon, and our Principal Industry Analyst, Dean Croke. Welcome, guys.
Good morning. Glad to be here.
Morning, Ken. Morning, Ned.
Has spring sprung for you all?
Yeah, the daffodils are up in the yard. The trees don't have leaves yet, but you know, it's getting a springy feeling.
What about you, Dean?
Yeah, same here. The birds are chirping, so it's always a good sign. We've got terrific winds here in the northeast this week, but there's definitely a hint of spring in the air. We're into the 40s this week consistently, so we're out of the deep freeze, I think, for winter.
This is the real sort of personality disorder weather time in Ohio, where today the wind chill is like 5. I think it's supposed to be 60 in the next couple days and then back down. So at least it's sunny. I'll take it. Signs of things to come. So for those not familiar with our show here, we're here every Tuesday at 10 a.m. Eastern, talking about trends in the freight market, things that we're seeing, things we think are important for you to kind of keep an eye on. But most importantly, we're here to answer your questions. So please feel free to drop questions or comments or kind of anything that's on your mind in the chat or comment section below. And we have a team of folks that will get that over to us to address towards the end of the program. So with that, I'm going to jump into our key points of the week. It's no surprise that we're going to be talking a lot this week about weather-related issues that we've been seeing over the last couple of weeks and the effects that's had on the freight markets. But overall capacity is tight, disrupted networks. We have some interesting feedback we can share, some anonymous shipper feedback, as well as some feedback we've gotten from large carriers. So you're going to see this reflected in the rates. And a lot of these charts are going to look very, very odd. So Dean will help steward us through that and explain as he goes why they look that way. And I mean, it all kind of, the big sum of all of this is we're seeing record volumes to the point where, we're talking with our engineering staff about, preparing for abnormally, like things that you only see around Thanksgiving, on our server load for load board and rate view and things like that. So with that, I'm going to turn it over to Dean to walk us through some of the why behind these trends. Dean?
Yeah, thanks, Ken. It looks like 2021 will certainly be setting some records, just like 2021 did, especially in the load board market. Lots of disruption in the freight market last week. A lot of people are still playing catch up as the weather warms. So if we have a look at our load board for dry van, we can see that volumes continue to surge last week. If you look at that red line, you can see another steep increase. They were up 28% week over week. That's still, that's the second week after the severe weather disruptions. There was a significant reduction in truckload capacity across the eastern half of the country, which helped tighten capacity and push up rates. So truck posts on the other side, truckers posting their equipment. It returned to more seasonal levels, so it pushed up the load-to-truck ratio by 14% to 10.88 last week. So still pretty high for this time of the year. Similar story in refrigerated. Temperature control sector volumes are more than triple what they were this time last year. Volumes were up 15% last week, and along with 15% more trucks posting for loads to take advantage of higher spot rates, the load-to-truck ratio stayed almost identical at 21.15 this week. In the flatbed market, you can see it's tracking very similar to the 2018 market, although there are very different economies. The similarities are striking. Load post volumes continue to rise last week. They were up 26% week over week. Load to truck ratio is up to 77.66. In the market condition index charts, lots of activity in the market, dry van load post volumes in our top 10 markets. That's about a quarter of our volume, up 15% week over week. Texas was the hardest hit market, of course, by the cold. The damage that the polar vortex caused has driven up inbound volumes. That's a lot of freight's being hauled in there for the rebuilding effort. So when I look at the three equipment types on the inbound side to the 11 markets in Texas, 11 KMAs, dry van volumes are up 25% week over week, reefer up 28%, and flatbed up an amazing 53% week over week. That's all inbound loads to the Texas market. Texas inbound volumes are now more than double from the week prior to the polar vortex, to give you a sense of how much the market has changed. The other big story this week is, of course, intermodal. They're still struggling to get their networks back in order, especially on the West Coast following Union Pacific's 72-hour shutdown. If I look at the 5 major markets that Union Pacific serves on the West Coast, volumes are up 21%. Last week, they were up 31% the week before. So there's still volumes flowing over into the truckload market as shippers look to move some of that traditional intermodal freight. Spot rates in those 5 Union Pacific markets are up 22 cents a mile last week to an average of 261. In the refrigerated market, load post volumes are up 10% week over week. They're up about 16 cents a mile in our top 10 markets. The only exception was Elizabeth, New Jersey. Volumes are up 22% week over week, but capacity loosened. Rates dropped 7 cents a mile to 241. Some other markets really struggling to find capacity. Twin Falls, Idaho. Volumes are up 13% week over week, but rates increased for the 3rd week in a row now, jumping 31 cents a mile last week to 277. Volumes in this region generally are up about 38% from 2 weeks ago, and there's a real shortage of trucks for some of that traditional winter produce, such as apples, pears, onions, potatoes, according to the USDA. Similar shortage of trucks in Yuma, Arizona. That's our winter salad bowl. About 95% of our leafy greens come from this one little area down on the Colorado River on the border. Lettuce volumes are down this year as a result of the pandemic, but rates are up. Reefer rates from Yuma to Dallas are up 60 cents a mile last week to 369. To Chicago, up 30 cents to 292. And they're up by about the same amount for loads to New York, which averaged about 336 a mile.
Hey, Dean, I want to jump in and ask you a question real quick.
Sure.
Like the second headline story this morning on the morning news was the Texas, some of that leafy green crop, freezing over due to the cold. Do you foresee that being an impact that could stunt some of the produce coming out of the South? Because it's kind of, the cold permeated much deeper south than typical. The areas that are usually not impacted. Do you see that?
Yeah, absolutely. I'm writing about it this week in my weekly update. In fact, I did a study on the Rio Grande Valley. Ken, out of the 40 vegetable crops grown in the Rio Grande, only 3 are likely to survive. That's onions, cabbage, and potatoes. So the winter crop down there has been decimated by the blast of cold air. And of course, cabbage is the main ingredient for the St. Patrick's Day celebrations. So the current talk is that there'll be a shortage of cabbage for the big St. Patrick's Day event on March 17. But the freezing temps damaged more than 95% of the Valencia orange citrus crop. So there's lots. I don't know how much inventory they've got in storage. So I expect that we'll see much lower volumes out of the Rio Grande Valley in the next few weeks in particular.
Yeah, it's funny you say cabbage. That was the actual focal point of the story that I was listening to this morning, was the cabbage.
Oh, okay.
But they were they were decimated.
Yeah.
They even had some, smaller I don't know, do you consider chickens livestock? But they had some chickens actually, some of their chicken.
Right.
I don't know the proper way to say it, but they were affected by the cold as well.
Yeah.
All right. Sorry to jump in, but I was just curious what you thought.
Yeah, it's an interesting story. So there's more on that in my market update that'll be out tomorrow. So yeah, pretty much anything, reefer rates, anything into Dallas were high last week. Anything out of the West Coast were high. So lots of tight market conditions in the refrigerated space. Similar story in flatbed. Volumes increased about 20% week over week. Spot rates dropped by about 5 cents a mile on average in the top 10 markets. But that was the average was dragged down by a massive $1 per mile drop in Jackson, Mississippi, which was our 5th largest load post market last week. Rates dropped to 269. So absent that data point, rates in flatbed were up about 5 cents a mile across the top 10 markets. Capacity's been really tight in the Cleveland market for a number of weeks, but it did ease last week. Rates dropped down about 14 cents a mile. Different story on the East Coast in Baltimore, which is the largest US port for imported machinery, particular roll-on, roll-off freight that comes in from Europe. Outbound loads post were down 3% week over week. The capacity remained very tight for those flatbed specialized type carriers. Rates are up 28 cents a mile to $3.14. So wrapping up this week's market index with a quick look at our year-over-year spot market, you can see a nice U-shape to our red line there. That's the current spot rate situation for this time of the year. It's the first winter storm in the post-ELD era. I think that's had a big impact with carriers' ability to rebalance their networks. Spot rates increased by 11 cents a mile to $2.35 a mile last week, excluding fuel. That's 81 cents a mile higher than the same week last year when they were $1.53. I did some back of the envelope math. I took the federal highway weekly mileage data from the interstate highway system, and the amount of miles that we were down during the polar vortex was something in the order or equivalent to about 600,000 trucks 40,000 trucks being taken off the road during that week. I did some comparisons back to the typical reduction in capacity we see between Christmas and New Year, when a lot of drivers, of course, take time off to be at home. It was a similar reduction in capacity during the polar vortex that we typically see between Christmas and New Year. We lost about 108 million miles during the polar vortex week. So it's about the equivalent of losing 7% of the industry's capacity in that 1 week. In refrigerated, not a dissimilar story. Spot rates jumped 5 cents a mile to $2.59, excluding fuel last week. They're now 31% or 80 cents a mile higher than the same week last year. And wrapping up with flatbed rates inched higher last week. They moved up 2 cents a mile to $2.31, and they're up 44 cents a mile compared to the same week last year, but tracking closely along the blue line there, which is 2018, as you can see. So that's it for this week's market update. As I've said earlier, if you want to find out more about what's happening in freight, go to dat.com/market update and download the weekly market update tomorrow. So that's it, Ned. Over to you for the forecast.
Well, the forecasts this week are going to be a little bit exciting. The polar vortex has certainly been surprising, not entirely expected in our suite of models, but they're adjusting. So let's go through and talk about it. So here you can see our dry van forecast. You can see the blue line is the market rate observed by DAT. The red line is our short-term forecast, and the green line is our ratecast forecast, with the gold and silver lines representing our blended forecast, which are mixtures of those two forecasts in different amounts and in different ways. So ratecast is kind of expecting there not to be a sudden sharp jolt downwards. I think that that's something that we're going to get into in our Ask IQ question for this week. But the short-term rate is expecting things to keep going up, and I just don't see that happening. I think that this was a semi-one-time event, and as networks rebalance, it's going to tend more towards the ratecast rate or a little bit lower than the ratecast rate. The sort of seasonal pattern is a little bit of a dip going into April, and then leveling out. We'll see. Moving forward to the reefer rates. Again, the blue is the market rate observed by DAT. The red is the short-term forecast. The green is the ratecast forecast, and the gold and the silver are our blended forecasts, which are mixtures of the two in different ways and in different amounts. And here you can see ratecast is expecting the level to be preserved with maybe a little bit of a drop before balancing out, whereas the short term is expecting continued growth, although that growth is slightly muted. Finally, we're going to be moving to our flatbed forecast, where you can once again see in blue the market rates observed by DAT. Red is the short-term forecast, which is straight up and to the right. Green is our ratecast forecast, which is flat for a bit and then heading up into April. I'm not sure how much that's going to be borne out. But we'll talk about that in the Ask IQ question. And the gold and silver are our blended forecasts, which are mixtures of the short-term and the ratecast forecast in different amounts and in different ways. And I feel like I've been teasing this a lot, but it's time to go to our Ask IQ question, which is, let me get the exact wording. What was different about this polar vortex that caused the market to go into a frenzy? Because a frenzy is definitely how I would describe the way that rates and load to trucks have been behaving.
Maybe I'll start, and then you guys can correct me and then add more. The main word that keeps coming up when we talk to folks, whether they're shippers, carriers, or brokers, is fragility. And I think that really is what is the main culprit here. Typically, in years past, when we have a hurricane or a polar vortex or a port disruption or whatever the case may be, the market's vast enough and liquid enough to metabolize those shocks. They may be short-term shocks. And we're sort of redefining what disruption means, but historically that might be 8-10 cents and 10-20% increase in load to truck ratios. What we're not used to seeing is these, like last April with the COVID related stocking outages like this. So I think the force being applied to the market is not much different, but the current state of the market and its ability to metabolize and adapt to these things is a lot different. And that's why you're seeing a consequent change much, much higher, or at least much more volatile than we have in past events. But with that, I'll kick it over to you guys to get your opinions.
Yeah, I'll have a crack at it, Ken. I look at it from a capacity perspective. I think capacity tightened, much quicker than I thought it would. But when you think about 70% of the country was covered in 6 inches of snow during that particular week, and then you look at interstate highways that were shut down and closed. Some highways were unplowable. They didn't have equipment. They didn't have salting equipment. So when you think about, this is, as I mentioned earlier, this is our first big major storm in the post-ELD era. And I think from having been a driver that's driven under both regimes, paper logs and electronic logs, I think that's had a fundamental difference on the fragility of the networks, because in heavily optimized networks where time is your biggest constraint, when everything works well, everything has to run smoothly, and that means you have to have a good flow of traffic. You have to have a high average road speed to maximize your miles at each 11-hour shift. And when you have roads in the conditions like they were in last week, and you drop down to 30-35 miles an hour, like some of those trucks were even stopped on the I-40 for 4 or 5 hours, that creates a massive backlogs through the networks. And I talked to some drivers, and a lot of them were just simply out of hours. They had to either repower loads. Some had to just take their 34-hour restart because they had no ability to do anything other than take the 34 while the storm passed and then get back on. And of course, what that meant was all of those loads were out of sequence, and the trucks were out of sequence. Another carrier told me that because of the storm, they had more difficulty getting drivers home. So they had to run multiple loads to get a driver home, and that took more time. So their trucks were out of network because of the storm, also because they had to take different routings to get back home depending on load availability.
The thing I'd add is, like, from a modeling perspective, that this is kind of a bad analogy, but you can think of shocks as being additive, or you can think of shocks as being multiplicative. And I think that depending on the regime that you're in, and we're definitely more in the multiplicative regime, where if like one bad thing happens and another bad thing happens, it's not, to the capacity network, it's not, the impact isn't 2 level worth of bad things, it's like 4 worth of bad things. It's super linear growth. And, whether or not that's partially influenced by the ELD or like ongoing just issues with supply chain imbalance due to COVID or what's going on, it's certainly, I think fragility is absolutely the right term to describe it.
Yeah, just let me look at let's look at it through just the lens of intermodal. Losing that intermodal capacity in a few key markets was enough to essentially tank. If you think about capacity as like the total amount of latent capacity to move things from one point to the other through all feasible modes. So we'll take out like horseback and river barges, and it's like the most applicable modes, which would be like LTL, point-to-point truckload, dedicated fleets, intermodal, and we'll take out like carload type, commodity type rail stuff. Just seeing that intermodal evaporate and having, as Dean mentioned, some compression on time, right? Because it's not always T-1 day from ELD implementation to ELT implementation. Those trucks didn't poof and evaporate like the Avengers movie, right? They just lost the ability they lost hours. Mm-hmm. So that's, capacity really should be measured in hours, not power units or trucks and trailers. At least that's my perspective on it. Yeah. So the market, the capacity pool wasn't able to handle that, right? When you're dealing with issues at shipper docks and longer load and unload times, those hours get cramped, and then all of a sudden you're in this huge squeeze.
Right.
And candidly, we can't share even the industry where we're hearing these feedback, but we're hearing feedback from multiple shippers that they think admittedly internally as well as within their peer groups, they panicked.
Mm-hmm.
When you're already dealing with inventory and shelf stockage issues, I think you'll do we're hearing that they did pretty much whatever it took, and the easiest way was to throw money at it. So that's why you're seeing $5 to $7 a mile from Chicago to Houston in some instances.
Yep. Ken, the West Coast was particularly interesting because we had such a backlog of imports coming in already. Rates had been trending down pretty much for the 4-week period prior to the polar vortex. So what happened when it hit and the intermodal volume started to flush the truckload market, what it did, it took away for a lot of shippers that intermodal door-to-door move once imports come into the country. We, in my market update this week, we're talking about one particular import containing units of bed sheets to Orlando, and the delays, the 14 days the container sat at anchor off Long Beach, took out the intermodal door-to-door move. So it meant it had to go on a truck. And of course, if you've only got 5 days to move 2 containers to Orlando out of Long Beach, a sleeper team is the best option. And the containers were going for $9,000 per container one way. And if you do the math on that, it's about $3.60 a mile. So the shipper lost a bunch of money on this particular move, but because of the duplicity events that Ned talks about and the volume of freight and tight capacity that already existed, any additional volumes that came in was, you had to pay a lot to get it moved.
All right, so I think that pretty much settles the question. A lot of people ask, where we get these questions? So a lot of times it's either a direct question to our Ask IQ inbox. Other times it comes from, between Dean, myself, and our sales and product teams, we're probably talking to customers 50 plus times per week. And we get a lot of these questions, so we try to tee up what we think is going to be most impactful. But if you ever have a question and it's not during a live show, you can always send it to askiq@dat.com. And usually we sort of amalgamate and package those into one broader topic to cover. But again, if you have a timely issue, feel free to drop it in the comment or chat below, and we'll spend some extra time today, if we can, to get to all of them, because we know that there's a lot happening right now. So, Ned, I'll turn it over to you. We have a bunch of questions already.
Oh, yes.
So
Reagan asks, do you see the impact from winter weather continuing to impact capacity into this week?
I'll have a crack at that. I think it'll take another week for networks to rebalance themselves, provided winter stays relatively benign. And that said, there's still some pretty nasty weather in the top tier of the country. So it'll certainly take the rest of this week, and my guess is into next week also.
We have a question from Scott. I think I can handle this one. What explains the difference between RateCast and the short-term rate forecast? RateCast is using our RateCast algorithm. It's looking at sort of an overall market picture that includes a lot more pieces of information. Short-term is basically just looking at what the short-term trends are, and it has a lot less seasonal information. Like an analogy that I like to give is that short term is going to expect that the current trends will keep on trending, whereas the RateCast is kind of biased in the direction that the trends will balance themselves out over a longer period of time. That means that when the trend keeps trending, like we saw in the middle of last year, the short term does pretty well, but the RateCast model does significantly better the vast majority of the time.
Just to kind of distill that down so that I would understand it. So, I mean, if you think about all the different ways you can model and kind of tying it back, the short-term model is sort of like Twitter as it pertains to news. All right, when something's and Ned, jump in if I'm misexplaining this. It's going to react to, like, someone driving, I know this is kind of a sad thing that happened, right? But the person driving down the road that saw the Tiger Woods thing, right? That was the first to market with the news, right? They're going to overreact. Is he dead? Is he alive? Is he going to ever play golf again? And like RateCast is more the mainstream journalistic process where they're going to take in all the information. It's going to compare it to like what they know. They're going to take in some of these sort of very, very short-term news snippets that they have and then come out with a more comprehensive story so as not to drive anyone into a panic, but then also not miss any of the important short-term details. So through that lens, that's really how And that's why we don't put the short-term model into production. It is, at least by my own, and I won't attach this to Ned. I'll take the heat for this one. The short-term model is an inferior way to do this. It's why we don't put it into product. It's a fun way to look at the market because it informs like what we see happening short-term and how sort of an independent robotic algorithm thinks about things short-term. But we don't put it into product for that reason. It is too frenetic.
I giving the short-term with like context I think is really helpful, but just like dropping that number on a website I think would just cause a lot of unnecessary bad interactions.
Others might, right? I think we were all kind of joking about a post we saw on one of the internet journalist things yesterday that in between all the sentence fragments and incorrect basic arithmetic, kind of talking about essentially using a short-term modeling approach to model national rates with 89% accuracy. But again, that's why we don't put these things into product, because it's just what we believe is it's not the correct way to do things. But we have a ton of questions. We'll quit talking.
Trace asked, do you think flatbed rates will continue to increase throughout the year? That's a tough one.
I'll have a go at it.
Sure.
I'll go out on the limb. The similarity between 2018 and this year are interesting on a number of fronts, both spot rates, load post volumes, and load to truck ratio. They're tracking, 2018 was considered one of the tightest capacity markets in a decade. It was typically a flatbed driven market driven by industrial volumes being up. We're starting to see a similar thing now with latest manufacturing numbers showing that things are starting to improve. And I was listening to Jason Miller talk last week, and he was talking about 63% of all ton miles come from the manufacturing sector. And it kind of got me thinking about, of course, manufacturing can both be in a flatbed and a dry van or a refrigerated van for that matter, depending on the commodity. But as the manufacturing sector improves and we've got this increasing demand for single family homes in particular, we've got the possibility of an infrastructure bill, which means more gravel, bridge spans, all those sorts of things to haul. I think there's a lot of opportunity for demand to be very strong in the flatbed sector and spot rates to remain tracking along with 2018 levels. That's my best guess at where they're going. The other thing is, though, with spot rates very high in dry van and reefer, flatbed trucks can also drop in under those dry van and reefer trailers to add capacity to that market, which is what we saw last year when a lot of refrigerated trailer operators dropped into the dry van market because rates were higher in dry van than they were in reefer in certain markets.
I mean, my 2 cents here is I'm not smarter than the market, but I would place a lot more downside risk than upside risk going into the rest of this year. I would expect, I don't know what's going to happen necessarily. We can kind of peek into the crystal ball a little bit, but in the like space of outcomes, I think there's a lot more room for rates to go down than there is for rates to go up.
For flatbeds, Ned?
I mean, it's just so unseasonably large, like these numbers. Maybe I'm being crazy.
I mean, look, my perspective, anyway, we'll be proven right or wrong on this, right? I'm not going to bet a hat on it, but
no, agreed.
We had Miller transfer in here, and that video is going to be coming out in a month or so. Just for an amazing conversation. It's just the things that I would never think of, right? They're more exposed in the industrial side of things. They're not hauling lumber or coiled steel. They're hauling machinery, kind of more upstream of the commoditized stuff. And I think, if industrials come back, if the oil patch is, if oil's still high and we're seeing activity out there, I think it could be a bullish year for flatbeds. I think it could be the one that sort of shakes loose the downside risk that we could be seeing in reefer and dry van. Yep. But again, if we see sort of a stepwise increase in inflation and interest rates and the housing sector shrinks up a la 2008, I think your reality will be the one that I think we'll be experiencing.
I just am nervous about, like, can people really be making profit on like $3 a mile? I mean, not people. I mean, shippers be making a profit on like $3 a mile flatbed loads, because like we're not that far from there.
Yeah, I mean, again, we need to do a better job. If today, the theme of today's episode is being a little self-critical, I think we could do a better job parsing that out, because $3 a mile for an oversized with a chase car and it needs a permit,
Mhm.
and stop signs removed and trees cleared is a lot different than $3 a mile for coiled steel going
Right.
400 or 500 miles. So I think if things shift, even within the distribution, I think you could see higher rates even if the gross market isn't going up. So that's sort of what I'm thinking about. And it could go the other way, right? We could see a lot of if like steel and the automakers get back to rocking and rolling, some of that commoditized flatbed freight is cheaper. So without the market moving at all, you could see a shift to lower, the lower side of the distribution. All right, we're getting the move along here, Ned.
Yeah.
So
Gary has many questions. Gary asks, if I want to bid on multiple stop loads, should I weight each lane's data based on, essentially, should I like weight the whole thing, or should I weight on a per lane basis?
that's a great question. I can tell you what I did. I took the kind of the initial origin and the final destination, and then add a per stop charge and multiply that by the total mileage. That was, of all the different pricing methodologies when I was in industry, whether it was for brokered or asset-based, that was the methodology that, because if you just add all of the individual trips out of RateView, for example, you're going to be, if it's a 3-stop load, you'll be triplicating sort of the fixed cost allocation across all 3 of those shipments. So my best advice would be to take the original origin, the source, and the sink. The origin, the ultimate origin, and the ultimate destination. Add in whatever your stop-off fee is, even if it's an internal fee, if it's not a published accessorial, and then multiply it by the total stop mileage, and use that. If you want to get real fancy, you can assume a load and unload time. If it's, I'm assuming it's live load, if it's multiple stop, and calculate a rate per hour, and then divide that by the miles. But that's getting even a little fancier. But I would not take each segment and create an additive price.
Right.
I mean, way high.
Yeah, just to add a tiny comment, I know that we need to be faster, but like a lot of the cost of a load is the cost for the driver to find the next load, right? Or for the dispatcher to dispatch them the next load. And a multi-pick, multi-drop, like you don't have that cost. You know where you're going next. So,
yeah, I mean, I think it's ultimately, to put a grander point on it, I think it's a source and a sink problem.
Yeah, agree.
So.
Gary also asks, once the shock is blended out of the market, where do you put the rate? Ratecast? I mean, that's where I'd go. I really feel like Ratecast is the speaking as the person who developed Ratecast, I feel like Ratecast is the best overall rate market forecast in the industry today. And I'm ruling out like individual like company forecasts of their own.
Yeah, I mean, I think this answers a couple questions as well as one that Ned will get to in a minute. But
yeah,
to me, the last 2 weeks, Ratecast is essentially punted. My supposition is either sometime this week or next, we will see some material contraction in the rates before we start seeing produce pick up. So
yeah,
I'm a bit bearish, or at least a little pessimistic on Ratecast accuracy over the next couple of weeks. I think it'll just be missing on the high side a little bit, but it should adjust though. Once it starts to see things go down, I think it'll kind of settle back into that seasonal trough.
Yeah, no, I agree with you. Just our producers also encouraging us to remind people that Ratecast is our forecasting product. So if you are a DAT RateView customer and you're interested in getting access to our forecasting product, that is Ratecast. That's what we're showing live. So
yep. Let's try to get a couple more of these, Ned, quickly.
Quick. Logistics Worldwide asks, how are carriers justifying the overinflated lane rates for the customers?
I mean, it's the free market, right? There's less capacity to go around per shipment that needs moved. And now, I mean, there are outliers. If you're on LinkedIn or any of the social media sites, I think you've seen examples of $10 a mile type stuff. I don't even think that warrants talking about on this program, but I mean, the higher rates are justified. There are more loads to move than there are trucks to move them. And in times of scarcity, a free market will dictate that prices rise to meet that. And if we talk about what we talked about, if you think back to what we talked about earlier in the show with intermodal, there's less total modal capacity, if you will. So rates are going to go higher until that is rectified.
Kenyon asked, this is our last question. Dean's comments in the first question, that is his answer, that I think that the impacts of the storm are going to continue for another week, seem to contradict the forecast models unless I misunderstand. Can you clarify? I mean, I'm not going to speak for Dean, but I'm going to say that I think that the impacts are still going to be there. So rates are going to be higher than they would normally be seasonally, but I don't see a lot of continued upside. Maybe. I don't know. Dean, what's your take?
Yeah, mine's based on pretty much anecdotal evidence, talking to carriers that their networks are still out of balance, but this week they're showing significant signs of improvement. So, capacity doesn't rebalance itself within a week. That's certainly not going to happen. That's why I think it'll take into next week before the networks start to rebalance and carriers get back into their weekly outbound, inbound, sort of leave from home, get back home cycles. That's what's going to take another week for that to happen.
Yeah, the only thing I'll leave with, and then I'll wrap, is Ratecast is a tool, and it should be a tool for you is the same way that it's a tool for us. I would not recommend throwing all of your insight and intuition out the window and fully trusting a model. I wouldn't do that. I mean, it should be an input, and the reason why on this program we talk about multiple different national models is we're showing you different ways to slice and dice and look and different assumptions. So if you're seeing things come off from a high rate perspective, I would blend that with what some of the modeling is saying to give you, help triangulate what the actual future rate's going to be. Use it as a tool, the tool that it is. And again, don't dismiss experience and intuition. So with that, we are well over time. I'm going to wrap this up. I want to thank everyone for joining us. Again, Dean's market update now more than ever is extremely valuable and packed full of information. Had you been in ostrich mode over the last couple of weeks, I think as a carrier, you'd have missed out on dollars per mile, potentially. So again, that's all made available for free on our website. We still do offer the DAT Daily 50 lane report if you want to shoot us a note at AskIQ. That gives you the daily update for 50 lanes with Ratecast. And also, I'd recommend checking out the Freight Find podcast. That's Chris Kaplis talking with industry luminaries about trends they're seeing both long-term and short-term. So with that, we're going to sign off this week. We will see you next Tuesday at 10 Eastern, and we hope you have a great rest of your week. Bye, everyone.